Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here is what's coming up on today's program. China provides the least cash to banks since November, amid signs that the economy is rebounding, while European stocks and U.S. futures trade higher. Goldman Sachs and Morgan Stanley round out U.S. bank earnings this week after JPMorgan and Citigroup benefited from higher interest rates. Meanwhile, Sky also reports that Barclays will cut over 100 investment banking roles. Plus, the French President Emmanuel Macron enacts his controversial pension reform after clearing a constitutional hurdle. He gives a televised speech later today. Now, first thing is first, so let's check on the markets. Now, the main story today, and this is the difference between the Euro Stoxx 50 and the Euro Stoxx 600, is that index, the 50, is set for its highest closed since December 2007. Now, this means that the Stoxx 50 has outperformed the 600 by far, with banking stocks actually resuming a bit of a rally following the brief turmoil in March. In terms of points, LVMH, ASML, L'Oréal, SAP, and Hermès have been the biggest gainers in the index, which is up some 16%, 16% this year, compared with a 10% for the rise 600. So for the moment, we're seeing a little bit of adjustment for the Euro Stoxx 50, but still, it's very close to that 2007 high. Let's also look at what European countries are doing individually. You can see there's quite a lot of green across the board, with the FTSE leading the gains. Now, Barclays is said to be planning to cut more than 100 roles in its investment banking division. Sky News reports that the job cuts won't be confined to a single country or function within the business. Now, for more on all of this, we're joined by Bloomberg's Charlie Wells. So, Charlie, thank you so much for joining us. What's been prompting these cuts?
Look, so this is not a great way to start Monday morning if you're in the investment banking division at Barclays. Now, what we've been talking about for the past year really has been this slowdown in deal-making activity across Wall Street, across a lot of these Wall Street banks. And just like Barclays, they have been making cuts in their investment banking divisions. Actually, Barclays, less than 6 months ago, made cuts as well. So this is very much in line with the trend that we're seeing. What we know is that these cuts are not necessarily going to be confined to certain countries, to certain roles, but that conversations are going to start this week.
Charlie, at the same time, we've had quite a lot of the big Wall Street banks reporting. What have we been learning?
Look, so sort of a different story there, right? So last Friday, we saw huge, upticks in some areas of some of these banks, setting the bar incredibly high for the banks that are going to be reporting earnings this week. So on Friday, we saw, JPMorgan, we saw Citigroup, we saw Wells Fargo showing, really good results as far as net interest income. We saw deposits tick up at JPMorgan. There had been concerns that maybe those deposit figures would actually tick down. And so the bar has been set very high.
So, Charlie, at the same time, there's quite a lot of earnings this week. What are we expecting? And then we have some great Bloomberg reporting on some of the smaller U.S. banks.
We certainly do. So there's going to be a lot of these other mega banks reporting. So Bank of America, there are some concerns that they may not perform as well as, say, the likes of JPMorgan as far as net interest income. But of course, we're going to get some like Goldman Sachs reporting more in investment banking activity there. But then, of course, these regional banks. And Bloomberg has this great big take out. It is about interest-only loans made by First Republic. And so a lot of the focus on these regional bank crises has focused on their underwater bond holdings. But this focuses on low interest loans for things like mortgages, where, wealthy borrowers could borrow for, long amounts of time at low rates and not have to pay back the principal for a while. That's causing trouble at that bank.
Charlie, thanks so much. Charlie Wells there with the very latest on the banks. Now, China has also injected the smallest amount of medium-term cash into the banking system since November, a sign that policymakers are actually watching the effects of past easing. The PBOC offered 170 billion yuan of funds to banks, resulting in a 20 billion yuan net injection for the month of April. Now, for more, let's bring Bloomberg Economics' David Ju. David, so what can we actually read from this in terms of China's economic recovery?
Yes, actually, what we are looking at is tomorrow's data, and we expect a strong rebound in the 1Q GDP. And we forecast a 5.8% year-on-year. So if it hits, that means that China's recovery is on the track. And at this time, we have seen the PBOC providing more liquidity to the commercial banks. It means that, in our view, that the PBOC want to continue to support the the economic recovery. So that, but on the other hand, the PBOC hold the MLF rate steady this time, and I think the PBOC, yes, it is the overall policy stance is supportive, but the PBOC want to avoid too much stimulus within the short term, which could be, they want to preserve the policy room with this. So anyway, we think that the rebound is ahead, and also we see more support.
So what is happening with deposit rates with some of the smaller Chinese lenders?
Yes, that is actually a quite interesting question that we have seen many of the smaller banks, they are reducing their deposit rate. This means that they are trying to reduce their cost for their liability. I think one of the reasons is that in the lending side, because of the fast expansion of credit lending, actually their interest rate margin has been lower over the past several months. So that this action was, aimed at to reducing their funding cost, so that to keep their margin relatively higher, so that to keep the business going.
All right, thank you so much. David Chu there from our Bloomberg economics team in Hong Kong. Now let's get straight to the Bloomberg First Word News. Here's Iain. Hi, Iain.
Hi, Francine. Geopolitical challenges posed by China are in focus as G7 foreign ministers meet in Japan. A senior U.S. Defense Department official told Bloomberg tensions with Beijing are high on the agenda. Japanese Prime Minister Fumio Kishida, meanwhile, resumed election campaigning over the weekend after a smoke bomb was allegedly thrown at an event he attended in central Japan. Kishida was evacuated unharmed from the site. Now, fears of a full-blown civil war are rising in Sudan as violence between the army and a rival paramilitary group is continuing into a third day. A long simmering dispute erupted on Saturday into a battle for control of the nation. Nearly 100 people are reported to have now been killed. President Emmanuel Macron has enacted his controversial pension reform after clearing a constitutional hurdle. The move was made possible after France's Constitutional Council approved the core elements of the bill on Friday, despite weeks of protests across the country. The law, which increases the minimum retirement age by 2 years to 64, will take effect in September. ECB President Christine Lagarde says she doesn't foresee the US defaulting on its debt. In an interview with CBS, Lagarde said she is confident the US will not allow that to happen, as it would have a negative impact globally. The Biden administration is locked in an impasse with the Republicans over government borrowing and related spending cuts. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, we're just getting some breaking news, and we will, of course, cover the Merck deal very, very closely. Merck buying Prometheus Biosciences for about $10.8 billion to bolster its research pipeline and strengthen its portfolio of autoimmune drugs. And on the back of that pre-market, you can see Prometheus gaining some almost 71% on the back of that Merck deal. So we'll have a full roundup of the deal and what it means for the biotech company, one of the largest pharma deals actually in recent history. Coming up, there is a cautious tone in markets today as investors weigh the prospects of more rate hikes and an economic slowdown. We'll have plenty more on that shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Friday's outsized reaction to the U.S. retail sales data saw yields rise and the U.S. dollar climb. U.S. retail sales fell for a second month in March, indicating that household spending is cooling. Now, for more, let's bring in our markets reporter, Valerie Teitel. And Valerie, I know you were looking at financial conditions, we're looking at treasuries, but break it down for us.
Yeah, Friday's move, a lot of people are seeing it as an overreaction, but it goes to show just how much the market was positioned for such a weak retail sales number. And when they didn't get it, two-year yields rocketed 14 basis points higher, and the market moved to price in a 25 basis point hike from the Fed in May, and some speculation that they might have to hike again in June. Now, we had this move in the front end. The dollar also strengthened on the back of that, unwinding a lot of its move weaker last week. But if we look to see what we have ahead of us this week in terms of what could possibly shift this yet again, what could possibly make us think that maybe the Fed won't hike in May, we have a few key events, which I can show you here on my next graphic. First, we get housing data, some key housing data out Tuesday and Thursday. And then on Wednesday, an important one, it's the Fed's Beige Book. Now, this comprises of anecdotal evidence from all of the Fed's 12 districts, hoping we can get some sort of hint on just how much the credit conditions have tightened in the broader financial system. And then on Thursday, we hear from 6 Fed speakers. That's ahead of the blackout period that comes on Saturday. And then the big data dump for the U.S. comes on Friday. We get the PMI data globally, but for the U.S. as well.
6 Fed speakers. Valerie, my head is already spinning. We'll have to keep a very close eye on that. Valerie Teitel there with some of the U.S. data later this week. Now let's bring in the conversation Iain Stealey, International Chief Investment Officer for Fixed Income at JPMorgan. Iain, great to have you on the program. I mean, there's so much going on. How much is the focus going to be on possible recession, the credit crunch, I guess, away from earnings?
I think if you think about what happened over the course of last week, I guess people are coming back towards this view that maybe there's a bit of a musing around soft landing, a bit of excitement around that. The way we look at it, though, is that still believe that as we go through the second half of this year, the credit crunch is going to take effect. The long and cumulative lags of monetary policy tightening is starting to bite. And we'll go through periods like we went through last week where a bit more optimism shows. And I think a lot of people are positioning for the recession. It's quite a consensus view out there. But ultimately, some of the survey data, some of the leading indicators we would look at would indicate that actually we are seeing a slowdown, particularly in the US. Maybe not so much around other parts of the world.
So, Iain, so first of all, what kind of slowdown are we talking about? What kind of credit crunch are we talking about? And where do you see it first?
So we're definitely seeing a tightening in lending standards. And when you look at some of the surveys, the senior loan officer surveys, subcomponents of the NFIB survey last week, a lot of these were also really before a lot of the sort of turmoil in the banking sector over the last few weeks or so. And they were already showing signs that we are starting to see the tightening that's gone through start to bite. I would expect more of that to come through. Is it going to be a really deep recession? I don't think that's the case, because when we look at consumers, when we look at corporations, they're still in pretty robust health at the moment. And also other parts of the world, like China, are reopening, and there's going to be a bit of a boost from that as well. But I definitely think the direction is towards a slowdown.
So to figure out the severity of the credit crunch, do you look at household spending or do you look at housing?
You look at, housing's obviously been the very first indicator to hit. And, that's very attuned to what goes on in the rate market. It happens very quickly, and then it's going to be more around the household spending. And obviously the latest, or the last part really, the last shoe to drop really is the jobs market and the unemployment picture. And you would expect as the recession really starts to bite, that's when the layoffs start to happen. So that's more of a sort of a lagging indicator. So some of the more forward-looking indicators to us are the credit condition surveys.
I mean, that means a whole more challenges, of course, for policymakers, and they try and figure out what they've done so far together with financial conditions that are tightening quite severely. What are you expecting from the Fed?
I think for the Fed not to go at the next meeting, you'd probably have to see something pretty dramatic happen over the next couple of weeks or so. So expectations from us is that they will go, and I think that's pretty much baked into the market. But it does feel as if, reading the last Fed minutes and listening, I say it'll be interesting to see those 6 Fed speakers come out this week.
I know, 6, I'm like...
But it does feel that they're sort of setting us up for that we're done. We're pretty much done, and that they would like to take a pause. I think the bigger question will be the cuts that are now priced in second half of this year and next year. Are they going to be able to be fulfilled?
Are you expecting cuts at the end of the year? I mean, it seems pretty... Again, I know we look at treasuries and we look at expectations for the Fed, but we haven't really figured out what inflation does from here.
Yeah, and I think that's the key question from the Fed, because inflation, it's definitely coming down in the US, and I think the readings last week, most people were looking at them as a good reading, and the numbers heading in the right direction. It's just that move from 8 or 9 to 5 is probably quite quite straightforward. It's that further fall down. You know, what does the Fed believe is good enough? You know, are they going to be happy with the direction of travel? Do they want to see an actual level? You know, is 2.5% going to be good enough on their core PCE measure, or do they actually want to see it hit 2? And then they also have to take into account that they know they've just seen over the last few weeks the impact of all the tightening that's happened. It has started to hit other parts of the market. Can they really be blasé about continuing to tighten or leaving rates at elevated levels? And I don't think that's the case. And I think they will start to be thinking about easing policy later this year.
But is it possible to separate what's happening with the banks to what's happening with inflation? Or, you know, the market is putting both at the same time because, of course, one links to the other. And so does the Fed have to do the same?
It does, but ultimately, if what's happening in the broader economy does lead to a slowdown, does lead to a recession, that is going to bring down inflation. And we saw that in the staff forecasts last week. So I think that's what the Fed needs to be focusing on, is what is going to be the impact to the broader economy, because ultimately, if it is quite a slowdown, that is going to bring inflation down off its own accord. So,
Iain, do inflows continue into some of the bonds, the fixed income space?
I think so. I mean, it makes perfect sense to us as a fixed income investor. But I think, you know, if you look at, where are the risk rewards? Well, ultimately, yields, yes, they can go a little bit higher, and maybe you get a slightly better entry point. But I still think the directory of travel over the next couple of years is easier policy and lower bond yields. And then you get your yields, you lock them in, and you get some capital gains on the back of that.
So what would you be buying right now? In the US and then elsewhere?
Definitely in the US. When we look around, places like Europe, they've probably still got a bit more to be done.
The bush doesn't look attractive.
They've definitely got some more to be done. But no, I think the US is the place where we're seeing the central bank coming towards the end of what needs to happen. And for us, really, it's the shorter end, the belly of the curve. There's been a lot of volatility in the very front end in the 2-year part, so I'll probably focus on 5 years at the moment from a risk-reward standpoint.
I was surprised actually by the fact, I wasn't really surprised by how China's reopening was affecting some of the stocks, but I was surprised by how we didn't see it coming in certain spaces. How does that read across go to fixed income?
I think it means you probably don't want to be looking at China fixed income at the moment because the yields there aren't that attractive. I do think when you think, where does China have an impact, it's on the export economies. Europe, as we've just been talking about, or you've just been talking about, so a big boost from some of the reopening there. And then the way we've thought about it, at least, is we were expecting this reopening from China, maybe not to be as dramatic as the rest of the world was over the last 18 months or so, but we know what happens when people are allowed out and allowed to do things and allowed to spend money. There is a bit of a boom, and that's going on in China, and we see that in the Chinese data at the moment. Probably not as much of a feed through to the US, though, as it would be to Europe.
Yeah, I mean, after 3 years of lockdown, you would expect something big. Iain, thank you so much for joining us. Iain Stealey, their International Chief Investment Officer for Fixed Income at JPMorgan. Coming up, the French President Emmanuel Macron enacts his controversial pension reform in the face of widespread protests. We'll have plenty more on that next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the French President Emmanuel Macron has enacted his unpopular pension reform after it cleared a constitutional hurdle last week. The law, which raises the minimum retirement age to 64, has sparked widespread protests. Now, legislation will take effect in September. Joining us now is Bloomberg's Paris Bureau Chief. He's Alan Katz. Alan, great to see you on the show again. So now that the pension law has been enacted, is it all over?
Well, that's a good question. So it seems like at least the unified front of union protests is likely over except for one day, which is May 1st. They've all planned to have a big mass movement on May 1st, which is Labor Day in most of Europe. And so it's a traditional day for union workers to protest. You don't strike that day because it's a holiday here in France and in much of Europe. Whether or not they agree beyond that, it seems less likely. The head of one of the more moderate unions, the CFDT, Laurent Berger, today and actually for a week now, has been saying that he can't see himself, pushing for strikes for the next 6 months. So it seems like at least that union, which is the largest one in France, is going to be unlikely to continue to protest against this. Instead, they're going to try to sort of work on the margins, on the details in terms of the actual application of this law to try to improve it in some ways for their workers.
So, Alan, we were looking at pictures of Emmanuel Macron's last TV interview, which kind of went down as a bullet. I think it was a bit of a PR disaster for him. Today, he's speaking on French TV again. What's he expected to say?
So he's likely to do two things. One, to say that, he somehow will try to present some form of empathy with the French, though he's really not very good at that. And as you point out in previous interviews, that's really gone down terribly. And the second thing he's going to try to do is say, like, actually, we have all these other things that we need to do. And he's sort of going to try to turn the page on retirement reform and say, like, we have all these other projects, and I want, to work together on all these things. But it's what he does every time, pretty much, and it really tends to fall on deaf ears because it really does it minimizes objections to retirement reform and to the concerns that people have about it, and so there's at least a decent chance that he will again sort of put his foot in his mouth and really anger the French people rather than sort of bring them together.
Thank you so much, Bloomberg's Paris Bureau Chief, Alan Katz. Now, coming up, as tech giants ramp up their R&D on artificial intelligence, we look at the implications for the future of employment. That's coming up next, and this is Bloomberg. China provides the least cash to banks since November amid signs that the economy is rebounding. European stocks and U.S. futures trade higher. Goldman Sachs and Morgan Stanley round out U.S. bank earnings this week after JPMorgan and Citigroup benefited from higher interest rates. Meanwhile, Sky reports Barclays will cut over 100 investment banking roles. Plus, French President Emmanuel Macron enacts a controversial pension reform after clearing a constitutional hurdle. He gives a televised speech later today. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, despite recent layoffs and economic headwinds, graduating high school students will be best off pursuing a career in tech rather than finance. At least that's a result of this week's Bloomberg MLive Pulse survey. Now, we asked investors which industry graduates should enter for the best career prospects given the rise of AI. I think we'll have a full roundup of what we found out on that. Now, our guest today is a serial entrepreneur who aspires to make creating apps as simple as ordering pizza. Welcome, Sachin Dev Duggal, Chief Executive and co-founder of Builder.ai. Sachin, first of all, explain to us exactly when you look at what you've built, this is, I want to create an app to simplify your life, or in some cases, maybe make your life harder. But I have AI helping me in doing that, so I can do an app faster. Is it better necessarily?
I think there's a couple of things. Today, every business around the world, every entrepreneur that's trying to build an idea needs software and to unlock their potential. It's no longer possible now for you to be able to do things the old way. But most of us don't know how to build software. Most of us don't know how to get it into the wild. Most of us don't know how to run it. What we found was that most software applications had the same features. But in fact, we were reinventing every single time. The second was that most people, if you gave them tools and say, go do it yourself, most people can't use Excel. So they're not going to build application software, whether it's web or mobile themselves. And so the power of using AI here is that we can actually help fill in the gaps of what someone needs, help put it together, and ship it out faster than if they were trying to do it themselves. But
Sachin, when you look at, for example, Bill Gates versus Elon Musk, I mean, one thing AI is like the death and destruction of civilization. The other one says, look, there's so many opportunities. Like, do we fully understand how AI will change our societies, change the way we live and work?
I honestly think we haven't quite grappled it yet. We have to sort of take a view of where AI is today. It's like the AOL of the internet days. We're really early, despite us thinking LLMs are the things that you talk about on the tube.
And you don't talk about on the tube?
I think the way to look at it is think about AI today, and the stage of maturity is a young child. When a young child is born, the parents' responsibility is to instill values. Values help a child create rules, good, bad, ugly. Today, what you've got is a child that has worldwide access to information, some hard rules, but no value system. And so you've got like a generative set of issues that could come out unless we get ahead of this.
But governments are trying to curtail it. Do governments actually understand what they're dealing with? again, AI is constantly evolving. We don't exactly know where it ends up, and it could be transformative for everything, even how we Google search everything at all, so how we find websites, how we interact with human beings every day.
And I think that's the key point, right? It's where you're using it. And so you've got sort of like the orders of risk. There's national security. You obviously do not want to be using it there. You've got things that affect your population. For example, like we were talking earlier on, right? Imagine a small country like Oman is using educational software powered by LLMs. But if that LLM data is using global data sets, it may be teaching things to kids that are not national views, but are more global views. And parents may not want that, for example. No. And then you've got things like, can you help me build a presentation? Or could you please generate a picture of Morocco at night? And I think for those things, it's vastly powerful. And so really, it's about the right use case being used at the right time.
Who's regulating it correctly? Because there's also, so many fakes. Everybody remembers the puffer jacket that the Pope wore, which is a deep fake. I think there was also things online about Berlusconi funeral, which was fake, but that looked really real.
The deep fakes piece is where you sort of enter being able to affect a population, national security, and I think today it's not being regulated. But one thing to keep in mind is how are these deep fakes being percolated into society? They're through the social media distribution networks, right? So whether it's a Twitter, an Instagram, a Facebook, potentially through search, but mainly through the more mass social media. And so I think this is where governments and social media companies need to work much closer together to instill checking at the boundary. We've never had a situation in history where such prolific content can be created, where it's virtually impossible to distill to the human eye whether it's genuine or not. It's a little like what happened in diamonds. Yeah. CVDs versus real diamonds. You needed a lab to realize it was synthetic.
But who's that lab?
I think it's a great question, and I think it's something that governments need to do because it affects their people. I don't think I think there can be a central body within an apex organization like the United Nations or organizations such, but I really think it's a national issue. And more so because these algorithms are being developed in other parts of the world. Data is being tagged in other parts of the world, and the population is being affected somewhere else.
Yeah. Do we need a new technology minister for each government? Because it's almost, I used to be told, you look on boards, if you don't have a chief technology officer that sits on the board, then you lose, like you might as well close shop. Is it the same thing for government?
I think that's a spot on view, right? And the question is this a political role or a civil service role, right? Yeah. To me, this needs to be a non-politicized role because the ramifications are so high. It's more of a civil service role where there's continuity between governments.
Sachin, I feel like we also underestimate the fact that machine learning changes with the kind of hardware that we input, right? The microprocessors and things like that. How fast? So let's say governments stand back and don't actually do anything to curtail it. How fast will AI develop into something else from what we have today?
I think it's a fabulous question with not a straight answer, because if you see what's happening with quantum computing, that will accelerate it at a phenomenal pace. But we're still quite early in quantum computing. But even if we look at modern GPU chipsets and how they're processing data, it's blistering speed. So I don't think there is any cap on how fast it can grow out. I think the sensibilities need to kick in now to make sure it does it at the right pace.
Yeah. So when you look at privacy, when you look at morality, how do you build Builder.ai so that anyone who can have a website protects, for example, data privacy? In Europe, we have GDPR and things like that.
For us, in how we build software, we don't touch the end customer's data. So one of the things that we took as a decision really early on is each application, suppose you were building something for
pizza delivery, right?
Pizza delivery. We actually have a customer that's doing that right now. Your data would sit within a segregated account, which only you can see. So we wouldn't use that data to make decisions for the next pizza person coming in. That being said, all systems are learning from conversations that they're having with their customers to make those customer conversations more enriched.
I mean, I need to sort out my apps because I have like 350 apps, it feels like, and I can't really find them. When you speak to your customers, why build your own app instead of going on Deliveroo? Apart from the money factor, are we going to have too many apps? Like, how many are you expecting to make with Builder.ai?
So I think the very nature of software is changing.
Yeah.
Today, you think about software applications, we think about them hanging on your phone for 6 months, a year. Yeah. In the next few years, this conversation could have software augmenting it. And as soon as we're off the camera, the software disappears.
Holograms? What are we talking about?
We're talking about software that could be in a desk,
Yep.
software that could be speaking into your ear. It's all software.
Deliver pizzas live as we talk about.
Well, not even
apps.
necessarily deliver pizzas, but it could just be to augment the conversation. And then, it's software being created at the speed of thought, software being destroyed at the speed of thought.
But Sasha, how do you augment our conversation right now? I mean, we're having a great conversation. What's AI going to help us? Is it the interaction with the viewer, or how does that change?
It could be the interaction with the viewer. It could be, we may be talking about, for example, Oman, and then suddenly data comes in saying what kind of systems are being used, how's the population. It's enriching the conversation. It's allowing us to keep a memory of the conversation, the things that we discussed, taking captured moments out of it. And that's really powerful. But, going back to your question around the 300 odd apps you have, what we've seen is there are about 20 apps that people use.
Yep.
The top 5 are global social media type apps. The next 5 are airlines.
Yes.
But the next 10 are local. And the bottom 5 are hyper-local. Your salon, your favorite Lebanese restaurant, your grocery store that's nearby. And you're never going to see that change, because the minute you go to local, every local is different.
Sachin, thanks so much. I'm going to delete my 258 apps because it's true. I mean, I do only probably use about 10. Sachin Dev Duggal, their chief executive and co-founder of Builder.ai. Now, coming up, UK inflation is expected to slip back into single digits this week. We'll have all of the details next, and this is Bloomberg. Now, looking ahead to later this week, UK inflation is expected to slip back into single digits, raising hopes that rate hikes from the BOE may be coming to an end. Now, for more, let's bring in Bloomberg's markets managing editor, Christine Aquino. So, Christine, thank you so much for joining us. Why are economists now expecting a slowdown in UK inflation?
Well, Francine, I think we've seen more signs of disinflation in the UK economy in general. If you look at some of the PMI surveys, we're seeing reports of businesses saying that they have lower prices paid, a little bit of less food inflation as well from some of the supermarket surveys that we've seen over the last few weeks. And so, and wages, of course, contributing to that as well, a bit of a pause in wage gains there. So I think overall, there is much hope that we're finally going to go down to those single-digit numbers that the government, for instance, has been very eager to see, although we've been down this road before. So, let's wait until later this week until we actually have the data to call it.
I feel like we've been asking so many times, can inflation go as fast as it came? And people say, no, you're crazy. But talk to me about the pound.
Well, the pound has been really having such a good run this year. It is the best performing group of 10 currencies so far, which you couldn't imagine saying if we were, just rewinding back to 6 months ago when we were still kind of picking up the pieces left by former Prime Minister Liz Truss's administration. But here we are. And a lot of factors contribute to that, of course. There is the dollar weakness story that we've seen ever since the start of this year, and really starting from toward the end of last year. That's really helped the pound. And then there's also a sense that the UK is avoiding at least the worst case scenario when it comes to growth, right? We're not seeing as many recession calls anymore. In fact, Bloomberg Economics, our economists there are saying that growth will remain flat. It's at least not going to go into recession. And so there is this feeling that at least we're not going to hit that ultimate growth slowdown scenario that many were fearing at the end of last year.
So what about the BOE deposit guarantees?
Yeah, well, this is, of course, very much a legacy of what we've seen in terms of the banking sector gyrations in March, right? And the BOE very much involved in that via HSBC's takeover of SVB's UK branch. But I think in general, it's also led them to kind of reevaluate the protections for deposits that we currently have in place. It's not very high. It's £85,000, which is way less than what we have in the US, which is $250,000. And so I think it's a good time. They're looking at it as a way to kind of reevaluate, given what we've seen in March, and potentially guarding deposits in case we saw a repeat, or we see a repeat of the turmoil from March and heading into later this year. Because you never know. This is the sort of thing that can be calm for a while up until it's not.
Yeah,
exactly.
Exactly, calm until it's not. Christine, thank you so much. Bloomberg's markets managing editor, Christine Aquino. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. London time in our half-an-hour special. special. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Sega has offered to buy Rovio Entertainment in a deal that values the creator of Angry Birds at about 706 million euros. The Finnish company's board has unanimously recommended shareholders accept the offer, which is backed by 49% of shareholders. Japan's Sega is doubling down on console and smartphone gaming as it seeks new ways to grow. Infosys shares have slumped in Mumbai trading following a wave of downgrades after the Indian tech company reported fourth quarter earnings below estimates. At least 10 brokers, including JPMorgan, Macquarie and Citigroup, slashed their ratings on the stock after the firm said it expects revenue growth of between 4 and 7% in the next fiscal year. Analysts had forecast growth of more than 10%. And Google is reportedly ramping up efforts to integrate AI into search capabilities. The New York Times says it's working on an all-new AI-powered search engine and also adding AI features to its existing offering. Samsung has reportedly considered swapping Google for Microsoft Bing as a default search engine on its phones, and that's due to Bing's AI features. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, pharma giant Merck is buying Prometheus Biosciences for about $10.8 billion, one of the largest pharma deals in recent history. It will bolster Merck's research pipeline and strengthen its portfolio of autoimmune drugs. Now, it will also cushion the loss of its patent for blockbuster cancer drug Keytruda. Now, for more on all of this, Sam Fazeli, Director of Pharma Research, EMEA at Bloomberg Intelligence, joins us. Sam, good morning. Thank you so much for joining us. So does this help Merck with its big generic exposure?
Good morning, Francine. Well, yes, I think it will go some way to chip away at that issue, which is starts in 2028. That drug Keytruda that you mentioned already, it's been a phenomenal cancer drug, not just for the sales that it's generating for Merck, but also for patients. It's basically treats something 15, 16 different indications. So expectations are, based on consensus, that it would be about $33 billion in 2028, about 40% of Merck's overall sales. So they need to do something. And here we've got something being done. It's a very interesting drug that they're acquiring through this company, but it won't be the end because it's unlikely to come to market before 2026. So it's not really going to have enough time to deal with that patent expiration.
So how exciting is the drug that Merck is acquiring through this deal?
Yeah, so it's a completely novel mechanism to treat two different facets of inflammatory bowel disease, so ulcerative colitis and Crohn's disease. And it has shown in phase 2 trials, in a pretty decent phase 2 trial, that it's got a efficacy that's above and beyond what's been seen before with other agents. The problem Merck will have, of course, when they bring this to market is that another staple drug in this disease, although lower efficacy, is going off patent also, and that's Johnson & Johnson's Stelara. So that dynamic will be quite interesting to watch.
So, Sam, give me a sense of, does this spur more acquisitions? I mean, this was one of the most transformative. I mean, it's a huge, huge, sizable M&A. Are we going to see more of that kind of thing?
I think so. Because, as you saw, some research that we did a few weeks back suggests that up to about $390 billion worth of drugs are going to be exposed to generics. That's not the revenue that the companies will lose, but exposed to generics potentially by 2030, between 2023 and 2030. That's a big number to deal with. That's almost close to half of total branded pharma sales potentially by 2030, if not quite exactly half. So pharma companies are going to need to keep doing this, and they're doing it. The ones who've got the capability are doing it.
Sam, thanks so much. Sam Fazeli, the Director of Pharma Research, EMEA at Bloomberg Intelligence. And then look at that, Prometheus gaining very significantly in today's trading session. Now, coming up as earnings season kicks off, we'll get a deep dive into what we should be watching out for. We'll discuss the likes of ASML, L'Oréal, and Heineken. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Europe's earnings season gets into full swings from this week with Heineken, ASML, Nokia, and SAP among those releasing results. Now, investors will be watching for signs of how companies are coping with headwinds such as higher rates and the banking system stress. Well, we're delighted to be joined now by Tim Craighead, Senior European Equity Strategist at Bloomberg Intelligence. Tim, I love all of your research. Well done. It talks about, the upcoming earnings season, who will do well, who will do badly. So what's your overall expectation?
So overall, I think it's going to be a tale of sector. There's some that will show very good earnings. There's others that are going to be under a lot of pressure. For example, if you look at the overall earnings picture, it's shaping up to be a 1 or 2% decline in earnings for this quarter. Now, on the one hand, we've got banks that with higher interest rates, you've got higher net interest margins, improving profitability, quite positive. On the other hand, you've got lower year-on-year energy and metals prices, and you've got a significant drag with the commodity complex. So, that minus 1 or 2% overall is got a big skew in both directions.
So what are we talking about? Margin, I mean, is there one factor that you're looking out for more than most? And we want to talk about technology and, of course, the fact that they laid off so many people. I don't know how that will do. Yeah,
so I think in terms of the themes or the issues to consider, one is going to be what happens with China. And whether it's the industrials, whether it's the consumer, whether it's some of the commodity complex in terms of demand, the reopening of China is quite important from the standpoint of driving global growth, but also providing another leg of growth because many of these companies, think the consumer space, for example, are facing tough year-on-year comparisons because Europe and the U.S. reopened last year first quarter. So it's an interesting dynamic there. So China is a big deal. Yeah. Commercial real estate is another big deal as it relates to the financial sector. We're all focused on banks last month with the stress that you had mentioned. But another one of those issues with higher interest rates is commercial property, which, you think who's coming back to office? Do companies want to revamp their workspace, et cetera? And what's happening with those values of office buildings and how does that play through the financial sector is going to be a big deal as we see from companies report this quarter.
So is that going to be the biggest source of stress?
I think it is a big potential source of stress. We would argue that the deposit issue that came up a few weeks back with SVB and Credit Suisse is probably one-off. But it's one of many issues that when you have such a spike in interest rates that you do have to look for other implications that can ramble through, and this is a big one.
Tim, thank you so much. As always, Tim Craighead there, Senior European Equity Strategist at Bloomberg Intelligence with some great piece of research. So we'll also push it out on social media. But if you're a Bloomberg Terminal user, and we hope you are, just check out Tim and his team's, of course, research. Now, this is a picture overall for some of these indices in Europe. Now, we're holding on to gains, but maybe without the conviction that we were hoping for, expecting earlier today. Now, this is a couple of things that we need to watch out for. First of all, the Euro area blue chip index, which is the Euro Stoxx 50, finally set for its highest close since the global financial crisis. I don't think it's gaining as much as it was about 15 or 20 minutes ago, but still, the gauge got a lift last week as luxury stocks rallied amid some upbeat sales. And then Prometheus, this is a company bought by Merck. Shares are jumping quite significantly after that deal, gaining some 70%. Bloomberg Surveillance Early Edition continues in the next hour with Anna Edwards in London, Kriti Gupta in New York. This is Bloomberg.
I think the whole narrative of economic policy making and who runs the show today has changed.
Central banks have to own their mistakes and have to learn from their mistakes.
I don't see inflation as on a secure path down. So I think the Fed has very difficult choices ahead of it.
Inflation is going to come down quite a bit on its own, but it will not come down to 3%.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The week begins with an $11 billion pharma deal. Merck is buying Prometheus in a bid to bolster its research pipeline and strengthen its portfolio of autoimmune drugs. Apple sales in India near $6 billion. CEO Tim Cook begins his retail push there as the country takes over some production from China. And a survey of economists suggests the UK is heading for a pause on rates as inflation is expected to slip back into single digits this week. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Kriti Gupta is with me in New York. Matt Miller is off today. And Kriti, a little bit of M&A news in the pharma sector, as we said in our headlines, also elsewhere here in Europe. That's lifting spirits in some places, but we have to wait a little bit longer for data and Fed speak. That really hits later in the week.
Yeah, a little lack of conviction here, lack of momentum, even as we kick off the week with, as you say, that merger mania news. On the macro front, though, a little bit quieter than expected. And just take a look at futures, for example, only higher by 0.1%. Yes, risk sentiment might be a little bit more positive, but still, again, not something that you can really kind of dive both feet in with. The two-year yield is what's catching my attention, though. 4.11 on the front end of the curve. Remember, one of the big issues of the past couple of weeks for the really bond bears out there was that the two-year yield kept hitting up against that 4% level. Then cue that retail sales data that came in pretty declining for the second straight month, and that actually shot the yield up much, much higher. The idea here simply being that inflation may actually be just a little bit more persistent than we thought, and for that reason, you could see the Federal Reserve continue to hike or even just keep their rates higher for longer. The terminal rate projections in the Fed swaps going up much, much higher, and that keeping that two-year yield firmly above 4%. Does it stay there is the question, though. Right now, only seeing a move about 1 basis point higher. The Bloomberg Dollar Index taking its cue from the yield picture, higher by about 0.2%. Again, no major conviction even in the FX market. But I got to say, the gold story continues to fascinate me. We are on record high watch. We're at 2010 on spot gold. Anna, 2060 is the all-time high.
Nice macro roundup there then, Kriti. In terms of where we are on the European equity space, broadly positive, only slightly though. A little bit earlier on, it looked as if the Euro Stoxx 50 index might take out those highs that we haven't seen since 2007. Yes, in 2023, we're still comparing back to highs of 2007 on the Euro Stoxx 50, long after the Nasdaq took out those levels and the S&P and even the Stoxx 600. Something to watch, but perhaps we won't take out those levels today by the close as things have faded just a little bit. That's what we see in the overall picture then. Flat to positive for European stocks. One sector that's really in focus is around technology, and actually we're seeing some pullback on tech names here in Europe. ASML is a focus here, but the sector as a whole, and in particular the chip making or the equipment makers that supply the chip makers, those are very much in focus. This after reports out of Taipei that suggest that perhaps TSMC might want to dial back on capex. That is certainly having an impact on some of the shares in that sector, as you see here. And here's Rovio Entertainment. Do you remember Angry Birds? If you've got an even longer memory, you might remember some of the properties owned by Sega. Well, Sega is buying Rovio, which is the maker of Angry Birds, and so as a result, the stock is up by 17.8%. Here's a bit more M&A for you. John Wood Group is going to engage with a bid from Apollo, so they're going to open up and provide more information to private equity bidders, Apollo, and so that's adding to the likelihood that a deal will be done there because Apollo has been trying to buy that business for a long time. And the pound is at 123.81. I just put this one in on the macro front, Kriti, because we do get some data out from the UK in terms of jobs and inflation, as we mentioned in our headlines. All of that due this week.
Yeah, and a ripple effect back into the dollar as well, something we're going to be keeping an eye on. So that's what you've got on the macro front. But as we mentioned at the top of the show, it's all about the micro, specifically the merger mania. Merck is buying Prometheus for almost $11 billion, one of the largest pharma deals in recent history. It's going to bolster Merck's research pipeline and strengthen its portfolio of autoimmune drugs, also cushioning the loss of his patent for blockbuster cancer drug Keytruda. For more, Sam Fazeli joins us, senior pharma analyst over at Bloomberg Intelligence. Sam, walk us through how this helps with generic exposure.
Yeah, good morning. 2028 is the year where this phenomenal drug that Merck has created, not just obviously for sales, consensus expects $33 billion in 2028, but also for patients. It's been a major improvement in cancer therapy. So we've got this drug that's going off patent. Consensus expects about $17 billion, $17.5 billion total revenue loss for this drug and a couple of others between 2023 and 2030 for Merck. So they need to fill that gap up. And this is one step toward that. We've called it a chip away at it rather than the solution. We don't think that the drug that comes with this acquisition is going to be on the market before 2026. So it's going to take some time, and it will have its own dynamics to deal with.
Okay, so chipping away at their own expiry cliff then, Sam. But in terms of the drugs that they're buying with this deal, you suggested you're not entirely sure they're that exciting, but how exciting could they be?
Yeah, the drugs are exciting. There's no question about that. But this is a disease area. In this particular case, it's inflammatory bowel disease, which comes in two flavors, ulcerative colitis or Crohn's disease. This drug has shown the best efficacy that's been seen for this disease ever. Obviously, that's not a head-to-head comparison. It's in separate trials. The issue is it won't be till 2026 that it's on the market. It will take some time to gain market share, et cetera. And they'll be having to deal with Stelara, which is a big drug currently on the market for this indication from Johnson & Johnson, which would have gone off patent. So it might still mean that people would be taking those cheaper drugs before their transition to this drug. We'll have to see how that dynamic works out.
Sam, thanks very much. Sam Fazeli of Bloomberg Intelligence with a heads up on the M&A that we're seeing in the drug space and what it means. Let's pivot to other corporate news. Apple sales in India hit a new high of almost $6 billion in the year to March, highlighting the market's increased importance to the iPhone maker. This as CEO Tim Cook arrives in the country to open its first local stores this week. Let's bring in Bloomberg's Alex Webb for more. And Alex, good morning to you. So did we expect this record number? I am actually quite surprised we don't have Apple stores in India already, given the tech-savvy nature of the country. But this is where the development is.
Yes, look, there's been talk for years that India is maybe 10 years behind China. That's maybe starting to come to fruition now. Like, these sales, they pale in comparison to the 25-odd billion that Apple does in sales in India. The challenge Apple has when it comes to opening its own stores is you have to have a certain proportion of the stock in own brand stores sourced from India itself. Now, it hasn't necessarily opened factories in India in order that it can open stores in India. That's actually more to do with trying to de-risk its China exposure a little bit. But having manufacturing in India does then make it easier to open those stores. And we do often see that where they have retail outlets, it does drive an uplift also in online sales, because people go in, get their hands on it, try it, see a bit of the experience, and then they come back later online and buy the devices.
And of course, we know that in India, Apple is not the main player. Samsung is, as it is with a lot of the emerging markets. Alex, let's pivot from Apple to Netflix, if we will. I'm not sure if you're a Love is Blind fan, but certainly a live stream failure for Netflix that has completely taken over the internet. Walk us through what exactly happened.
I am not a Love is Blind fan, but my wife is, so it does get played in my house more than I would care to admit. Look, this was supposed to be a big sort of Sunday night event. One of the real bastions of linear TV continues to be that Sunday night viewing when families, not to invoke too much of a cliche, sit around the TV and watch some of that event television. This was
you
a
can
real...
invoke that cliche. I'm sure they do it for Surveillance Early Edition as well.
They dared forward trying to go for that, right, by getting this live broadcast of Love is Blind. There were huge technical failures that people tried to get online. Netflix, they couldn't access it. It's a real sort of moment of embarrassment for Netflix. This is a real headline show for them. It is instead going to be available sometime today to watch in catch-up. They had advertised the ability to ask live questions to some of the participants in the reunion. Obviously, that didn't happen. So, look, is it going to be a massive blow to Netflix's earnings? No. Is it a little bit of embarrassment? Absolutely.
OK, thanks very much, Alex. Bloomberg's Alex Webb with the latest on a number of tech themes this morning. Let's get back to macro news. And UK Prime Minister Rishi Sunak is expected to receive a boost this week as inflation slips back into single digits, raising hopes that the quickest series of interest rate increases in 3 decades in the UK could be coming to an end. Our UK correspondent Lizzie Burden has an early heads up on the latest for us. Lizzie, what is driving the expected slowdown in inflation?
Well, Anna, it's a mix of petrol prices and core goods inflation. And in the next set of data, economists are expecting an even bigger drop. So, as you say, it'll be back into single digits, they reckon, for the first time since August. It's good news for the Prime Minister. Of course, he's staked his reputation on his top 5 priorities, one of them being halving inflation by the end of the year. The bad news is it's ironically going to take away some of the support that the pound has enjoyed recently. We also get the jobs data tomorrow. That's expected to show a slowdown in pay growth, so that will too feed into the inflation print.
Lizzie, then translate that on to what it means when it comes to expectations for the Bank of England here.
Well, it takes away some of the pressure for the Bank of England to hike again, but markets and economists are split on what Threadneedle Street is going to do next. Economists reckon that they're done with the hikes, but markets reckon you've got 50 basis points worth of hikes by September and more than an 80% chance of another hike at the May meeting. So too is the committee split. You've got at the hawkish end Catherine Mann, at the dovish end Silvana Tenreiro. She was saying in Washington last week that previous jumbo hikes have yet to fully take hold. And in the middle, you've got the chief economist Hugh Pill. He said last week there's scope to do too much, but there's also scope to do too little. So ING says all of this data that we're getting this week is going to be make or break for the May meeting.
Yeah, stuck between a rock and a hard place. Not a great time to envy being a central banker. Bloomberg's Lizzie Burden, we thank you as always. That's the macro front, the global story. Let's bring it back down to the micro here stateside as we get ready for another trading session in the U.S. stock market. We talked about the M&A news. We talked about the tech news. Now let's talk about the financials news, because remember, bank earnings are still continuing. It's not just the big banks that matter, it's the regional ones that matter as well. Charles Schwab, for example, reporting after the bell here. You're already seeing a little bit of optimism baked into the shares, higher by about 2%. Does that continue with some of its peers? That's something we're going to be watching throughout the week. Remember, Thursday is going to be the big day for all of the regional banks across the country. I also want to get a quick check on the cryptocurrency stocks here, because look, crypto is moving this morning, but you're seeing a bigger move in some of the players, the way to play kind of crypto, the miners specifically. Marathon Digital down about 4%. Riot really taking it on the chin, down about 5.5%. What's interesting here is that it's magnified more in the stocks, more so than it is in the actual cryptocurrency itself. So that's going to be something to watch. Is this an overreaction? Does this get paired into the opening bell, Sandra?
Okay, a lot of things to keep an eye on then as we get towards the open in the US. Coming up, back on the macro then, Christian Kopf joins us. Chrissy, Union Investment Head of Fixed Income, as we get further and further away from the financial services market turmoil that we saw in the month of March. How robust are fixed income markets right now? We'll discuss that. And we'll also talk to Sandra Horsfield, Investec economist, who'll be with us to talk about her view on the world. What have we learned about credit conditions on both sides of the Atlantic of late? What does China have to say? We'll get data from China in tomorrow's trading session. Plus, the future of work. We asked investors which industry offers the best career opportunity. We will bring you the results ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off, and he's missing a pretty big turnaround story. He knows that I'm obsessed with FX, Anna, and he's missing what's a really interesting chart here. Now, don't worry. Don't let all the colors throw you off. What's important to keep in mind here is that hedge funds are now looking at the dollar as a positive, somewhere to invest. And this is really important as we talk about the last couple of weeks where you start to see a major weakness in the dollar, mostly in favor of the euro. So I think we looked at 110 at the euro closing in last week. Now you're starting to see a lot of the smart money essentially say, look, we don't want to go all in on the dollar. And that makes sense when you are talking about the end of the kind of Fed rate hiking cycle. That's going to turn around, though, if you start to say, well, okay, inflation is persistent. Maybe we stay there. So essentially what this chart is showing you is that now hedge funds getting a lot more bullish on the dollar, changing their tune a little bit, and not necessarily investing in emerging market currencies or other areas of the world where central bankers are remaining very hawkish. Those interest rate differentials are no longer attractive, and they're saying, look, we are going to go all in on the greenback, and that's really where you see this kind of decline in positioning. But there are ripple effects for that kind of talk. Eddie Vanderwall, Bloomberg Markets editor, joins us here right on the show. Eddie, talk us through some of those ripple effects. What else gets affected?
Yeah, absolutely. I think there has been a little bit of an unwinding of that extreme bearish position against the dollar. But I think some of that can be quite easily explained, right? I think the Fed's priorities has been laid out for us very clearly. I think their top priority is financial stability. Second priority, inflation. And third only is growth. Now, if we take those in reverse, we have seen that growth is slowing a little bit in the US. But at the same time, inflation remains hot and the banks are looking a lot more stable. And that means that the Fed is probably, even if they only deliver another 25 basis points of hikes, it's it's less certain that they will deliver cuts later in the year. And I think that's the reason why a lot of investors are turning a little bit more bullish on the dollar.
Yeah, interesting one to watch, certainly, given how far we've travelled up and down in the Bloomberg dollar story. Eddie, good morning. Let me ask you about the UK currency, the pound. It's been a bit of a standout performer, perhaps to the surprise of some people.
I think so.
And then we're going to get some inflation data, jobs market data, a lot to come this week.
Yeah, absolutely. There's a lot to guess here, but because I think, you know, the market's pricing another 50 basis points or so from the Bank of England, which is more than the Fed, but less than from the ECB. And, you know, I think there's a lot of scope for surprise because the UK economy has, you know, we've seen a turnaround. The pound remains cheap versus the long-term average of where it's been. And again, it's just a little bit of that unwinding of the extreme bearishness. But if we see that inflation coming in hot yet again, you know, later on this week, then I think the Bank of England may just be forced into hiking as much as the ECB, and that therefore we see more upside on the pound.
And of course, the survey of economists suggests that inflation is going to come down back into single digits. But we thought that last time around, didn't we? We were wrong-footed.
Right, and look, and the pound will help. The stronger pound will definitely help on that front. So if we continue to see this strong pound, that makes our imports cheaper, and that will help the Bank of England in bringing inflation down. So hopefully, let's see.
Eddie, thanks very much. Eddie van der Veld of Bloomberg Markets Live with reflections on the dollar and some of the data out that could influence the pound this week. For more market analysis, check out MLIV Go. That's the function to use on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Now keeping you up to date with news from around the world, here's the first word. Gunfire and explosions rocked the Sudanese capital for a third day as diplomats intensified efforts to stop clashes between the army and a paramilitary group from escalating into a full-blown civil war. A long-simmering dispute erupted this past weekend into a battle for control of the nation. Nearly 100 people are reported to have been killed. Japanese Prime Minister Fumio Kishida resumed election campaigning over the weekend after a smoke bomb was allegedly thrown at an event he attended in central Japan. Kishida was evacuated unharmed from the site, and a 24-year-old man is said to have been arrested. The attack comes just weeks before Kishida is set to host the Group of 7 world leaders for a summit. President Emmanuel Macron has enacted his controversial pension reform after clearing a constitutional hurdle. The move was made possible after France's Constitutional Council approved the core elements of the bill on Friday, despite weeks of protests across the country. The law, which increases the minimum retirement age by 2 years to 64, will take effect in September. ECB President Christine Lagarde says she doesn't foresee the U.S. defaulting on its debt. In an interview with CBS, Lagarde says she's confident the U.S. will not allow that to happen, saying it would have a negative impact globally. The Biden administration is locked at an impasse with the Republicans over government borrowing and related spending cuts. Another sign of mounting pressure on the banking industry, Barclays is responding to a slowdown in deal-making and capital markets businesses by cutting about 100 roles in its investment banking group. The London-based lender already let go of roughly 200 positions from the same division in November. Anna, this is a story that has quite literally gone global as we talk about layoffs on Wall Street following the layoffs that you're seeing in the tech space. I wonder what is next.
Yeah, absolutely. And this is all to do with the investment banking part of Barclays. And that taps into a rich theme, doesn't it? Job losses from investment banking parts of the financial services universe. But Kriti, it's interesting to think about this on the day when we actually have quite a lot of M&A news flow. So we covered that pharma story in our headlines. We also talked about Rovio and the oil services business that is Wood Group when I was looking at some of the European movers earlier on. We just got a red headline across the Bloomberg that says THG, which is an online retailer based in the UK, not enormous, but still, saying that it got an indicative proposal from Apollo. So private equity interest in some of these businesses. Might that be enough as we put the turmoil of March behind us? Might this kind of news flow be enough to spark some life back into those M&A desks once again over at global investment banks?
Yeah, it's a very good point. But remember, M&A desk is only one part of that business. The other piece of it is debt and equity issuance. And with extremely high rates, there is this kind of discouragement almost baked into the market of actually accessing some of those capital markets. So you're seeing a little bit of a catch-22 almost, where even though there is more M&A activity, there is more deal activity, perhaps a sign of consolidation ahead of what a lot of people are fearing a recession is around the corner. On the other hand, you don't want to access those capital markets.
Right, and the outlook for rates then is going to be crucial, and expectations around recession tie into that, of course. We'll talk about all of that with our next guest then, Chrissy. Coming up on the programme, Christian Kopp joins us, Union Investments head of fixed income. After the turmoil of March, what does he think is the picture now for fixed income markets? Where does that leave Christian and his assessment of fixed income and where the opportunities are? Also, FX, he'll weigh in on where we are on euro-dollar. We went above 110 once again last week. Today, we're just below that, 109.74. So we'll get his views on the euro. Just how long can the ECB keep hiking if we do see a pause from the Fed? That seems like an important conversation to have in the FX and rates context. We'll continue to focus on those macro themes, all the M&A news of the morning as well. We'll bring you an update shortly. We'll get back to the markets in our next conversation. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The week begins with an $11 billion pharma deal. Merck is buying Prometheus in a bid to bolster its research pipeline and strengthen its portfolio of autoimmune drugs. Apple sales in India near $6 billion. CEO Tim Cook begins his retail push there as the country takes over some production from China. And a survey of economists suggests the UK is heading for a pause on rates as inflation is expected to slip back into single digits this week. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. And Kriti, we have some M&A to talk about today, and we have some news out of the financial services sector. Certainly that's a focus, the earnings story last week and this week. But in terms of the data, that builds from tomorrow onwards, doesn't it? And then we get Fed speakers aplenty come Thursday.
And for that exact reason, you're seeing a lot of investors, even in the pre-market on Monday morning, amid all of that news, sitting on the sidelines a little bit. And I think a great way to look at that is not just in the stock market, it's in the bond market, it's in the FX market. You are seeing it everywhere, that really lack of momentum. And that's going to be crucial as we simply talk about the futures action. Again, virtually unchanged, only higher by about 0.1%, the two-year yield at 4.11. And again, only higher by 1 basis point. For me, the bond market is extremely important right now because that two-year yield hasn't been above 4% for weeks, if not about a month or so. So that is going to be significant to see if it can actually stay up there and how it really relates to the Fed swaps and what they're pricing in for hikes throughout the summer. Remember, consensus right now has one more hike in May from the Federal Reserve of 25 basis points, but should the data support it, you could get more and then create a more repricing, and it kind of feels like we're starting to see a little bit of that on the front end of the curve. The Bloomberg Dollar Index taking its cue from the bond market higher by about 0.2%, and gold, of course, we are on that record high watch at about 2060. We're at 2010 right now, getting closer and closer. Let's get to some pre-market movers, though, because, Anna, you mentioned that M&A news. Prometheus is, of course, higher by 70% after Merck is talking about that $11 billion deal, really to amplify some of its portfolio. This is really important for biotech in an age post-COVID where they are looking to do more and more. We're going to dive into that throughout the hours on Bloomberg Television and Radio. Charles Schwab as well. You mentioned those bank earnings. We heard from JPMorgan, Citi, and Wells Fargo on Friday. We're going to hear from a lot of the regional banks this week. Charles Schwab reporting after the bell today, higher by 2.3%. A little bit of optimism baked into those shares. There's no optimism right now, though, in cryptocurrency stocks, and that's really where you're seeing a lot of the pain. More pain in the stocks than in the actual Bitcoin trading itself. Marathon Digital and Riot both down about 4 to 5% in the session, Anna.
Okay, so the crypto space in focus, along with some of the themes around banking and beyond. M&A, of course, a feature. M&A certainly a feature here in Europe as well, then, Kriti. But we don't see great moves on European equity markets as a result. The M&A story is coming at the smaller end of the market cap scale. So the Stoxx Europe 600 up by 0.1%. Some positivity at the start of this year around the luxury sector, the banking sector, tested during March, but coming back fairly strongly and back to those themes. ASML, though, a poster child today for the technology sector, which is really on the back foot today. Technology under pressure. And this is, we saw some headlines coming out of Taipei earlier on. Other media reporting that perhaps TSMC might want to dial back its capital expenditure intentions. As a result, that weighs on the companies that supply the chip makers, the likes of ASML. We've also got that M&A in focus then. Rovio Entertainment, if you remember Angry Birds, and maybe you have an even longer memory and you remember Sonic the Hedgehog, then you might be interested to know that Sega is bidding for the maker of Angry Birds, which is Rovio Entertainment. And so that company based in Finland goes up by 17% and more. John Wood Group, this is also an M&A story. Nothing concluded here, though. This is an oil services business based in Scotland. They've been approached by Apollo a number of times to try and do a deal. Now they've said they are going to work with Apollo. They'll open their data room to Apollo, so they'll get some further access. So that increases the chances that we might see some M&A there. Critty.
You know, I was never really into Angry Birds, Anna, I've got to say. Just not my cup of tea, if you will. I wonder if our next guest is Christian Koff, head of fixed income at Union Investment. He's going to keep us on track here. I wonder if he's into Angry Birds. It's fine. We'll ask him in the commercial break. For now, I want to ask him about this fixed income market. We're looking at a 2-year yield that is sustainably above 4%. And I'm wondering how much of that actually prices in the banking turmoil, or does it still have some ways to go?
Hey, Kriti. So look, I'm more into Happy Birds, I have to say. I'm not that much into Angry Birds. The 2-year rate at about 4% is pricing in another 25 basis points in rate hikes. In fact, what we look at is the June 2023 Fed funds future, and that is trading at 5.05. So in a way, what we've seen here is the rate hikes have been priced out because of the banking turmoil, and now they've been priced back in. But we're not back to square one. Remember that in March, June 2023 Fed funds future was actually trading at 5.5% yield. So what the market is pricing here is a terminal rate for the Fed, which is slightly lower than what we had prior to the banking crisis. And we actually think that this is justified.
So what does that then mean for a bond market if we do indeed get more persistent inflation, at least stateside or even in Europe as well? What does that mean for a bond market in terms of how quickly the repricing can happen? Are you at all concerned about the volatility we've seen in the last few weeks and whether this bond market can handle that?
You know, I think apart from inflation, we really have to focus on activity here. And in that respect, I think the interview that Janet Yellen gave over the weekend is quite remarkable. She mentioned that we do see credit tightening. There is a risk of a credit crunch, not just in the US, but also in the euro area. And that means that potentially central banks will have to do less rate hikes. This is also the main reason why the market implied terminal rate for the Fed is now below the levels we've seen back in March. So we are relatively laid back, I would say, and even sanguine on the outlook on the bond market here. We have seen a repricing now that was necessary because the banking sector turmoil is not as bad as people made it to be. But going forward, we really think that we're getting very close to the end of the rate hiking cycle. Personally, we see another 2 rate hikes by the Fed, not just 1, but 2. But still, that would bring us to the end of the rate hiking cycle pretty soon. And that is good news for the bond market. It's also good news to some extent for the equity market.
How do you factor in, good morning to you, Christian, how do you factor in what we've seen on financial conditions of late? I'm looking at a Bloomberg index, but other indices seem to paint, or indexes seem to paint the same picture, that during March, when we saw that tension in the financial services sector, we saw a real tightening in financial conditions. But now we've unwound that tightening, nearly all of it. And so I just wonder where that leaves us when we think about provision of credit to the markets.
Yeah, that's an excellent point, Anna. Those Bloomberg financial condition indices and the other financial condition indices which are out there have been calibrated in a period which was like 10, 15 years ago. And they look at the pricing of credit and the pricing of rates and obviously the pricing of the equity market. They don't really look at the supply, at the decisions made by the treasurers of the banks. And we are facing a situation here where we have seen a large amount of outflows of deposits from US banks. US banks are just not moving up their deposit rates to the market levels. There is a wide gap between what you can get on a 2-year T-bill and what you can get on a savings account or even on a certificate of deposit in the US bank. Because of that, deposits are leaving the US banking system, and they're also leaving, to some extent, the European banking system. And as a result of that, I think the treasurers of the banks will be quite reluctant to extend large amounts of credits. So you don't see that in the financial conditions index, but if you look at the senior loan officer surveys, for example, you can see that there will be some credit tightening, and that should make the central banks quite cautious in hiking rates again. So I wouldn't really focus that much on the financial conditions indices here. I would look at what are the banks doing.
Okay, yes, that very important point you make there. And some colleagues on the Markets Live blog told me something very similar earlier, that it's about those loan surveys and focusing on those. I wonder what you make of the European rate tightening cycle here, Christian, at this point then, given that we are either at the top or very near the top of the Fed tightening cycle, but Europe seems to still have some way to go. How much further can the ECB tighten after the Fed has stopped, after the Fed has paused? Do you see any tensions in that strategy?
Yes. So we think the ECB will do another 75 basis points of rate hikes, taking the deposit rate to 3.75%. And the situation we have here right now is kind of funny, because typically Europe is a very colorful continent where you have all sorts of debates, people contradicting themselves in the ECB Governing Council meetings and in the public. You know, they're throwing media stories at one another, and you always get a very wide variety of views on what central banks should be doing, while in the US it's much more uniform. This time around it's actually the other way around. You see that there is a broad consensus within the ECB Governing Council that they need to continue to hike rates, while in the US there's more of a debate going on here. We have people like the Reserve Bank of Chicago who are calling for a more cautious approach. You have Janet Yellen calling for a more cautious approach. So I think that actually we are moving to a situation where the ECB will keep on hiking rates while the Fed has already reached its terminal rate. And that means that the euro could move higher.
Well, speaking of the euro, let's bring it back and talk about the dollar very quickly. Are you at all concerned about kind of the bear case for the dollar here, if indeed you just laid out the euro piece of the equation, but the fact that hedge funds are piling in for a bullish view of the dollar, what would undermine that?
Well, I think the short-term positioning is actually on the other side. There is a lot of spec demand for the euro here. Now, we have two factors here which weigh on the dollar. The first one is the interest rate differentials. We will very soon move in a situation where the ECB will likely continue to hike rates while the Fed stops, which is positive for euro. And then you've got these more structural stories. You know, I mean, the governor of the People's Bank of China speaking about a greater role for the renminbi, President Lula of Brazil speaking about invoicing in other currencies than the dollar. You've got Saudi Arabia, which is considering to do some oil trading, which is not denominated in dollars. So there is a very slow-moving process here of people moving away from the dollar. And that's more of a structural story, which also tends to weigh a little bit on the dollar. But in the short run, what really weighs on the dollar is the interest rate differential.
Okay, Christian, thanks very much. Thanks for joining us. Christian Kopf of Union Investment. Really good to get your perspective. We'll continue some of these conversations. We'll be joined next by Sandra Horsfield, Investec economist. We'll get her perspective on the global economy. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Raymond James CIO Larry Adam. That's at 2 p.m. New York time. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Matt Miller is off today. Now, this week, the latest UK unemployment and inflation data releases will be closely watched amid a finely balanced debate on whether the Bank of England is done with raising rates. Joining us now is Sandra Horsfield, economist at Investec. Sandra, good morning to you. We thought that we might get a drop down in inflation last month, and everyone, including the Bank of England, was surprised by the fact that we didn't. What are you watching for in particular in the inflation readings and the other UK data this week?
I think on the inflation side, clearly the expectation is that this time we will get another step down back into single digits on the annual inflation rate. What's behind that? First of all, petrol prices. We know those fell quite a bit on the month and their base effects from the rise in the previous year. On top of that, the goods side of inflation does now seem to be sustainably turning lower. If you look at the supply chain disruption story, which was such a big part of inflation initially in driving up, That has now reversed. Shipping costs have fallen very sharply. Supply chain disruptions more generally have eased, and that ought to help pull down the annual rate.
OK, and so we watch services and see whether that also gets pulled down. And what does all of this mean for the Bank of England then? As I was suggesting, there is this debate as to whether we've seen the peak rate, yes or not.
I mean, it's very difficult to be satisfied with an inflation rate that's still going to be close to 10%, if not quite above it, from the Bank of England's perspective. We think that at the same time, a tightening in credit conditions of some sort is likely to be coming, and that in itself slows the economy. Plus, we have the sort of line of sight of low inflation coming through energy prices coming down, and that should help core inflation too. Core inflation also has elements of energy in there, and so that ought to pull down prices. We think we'll get one more rate hike in May, but then perhaps that's the peak rate as far as we're concerned.
So, Sandra, that's the monetary side of the equation. Now, for our global audience, factor in the fiscal policy. Anything from Rishi Sunak and his administration that could now factor into the UK economy? Anything on your radar there?
I think it's quite clear what the government is trying to get to. We'd like to be in a position to, ahead of the next election, be able to reduce taxation and sort of make good on those sides of hopes and promises within the Conservative Party. At the same time, we're dealing with very strong spending pressures still. We are still dealing with strikes in the economy. What will that mean in terms of, will there have to be more money put on the table to help, say, the nurses' strikes, the doctors' strikes? And what sort of fiscal headroom does that give? We were quite limited in terms of the amount of spending that could come. So perhaps the sort of general fiscal backdrop is still a difficult one in the UK and perhaps more difficult than in other places.
Sandra, can I ask you mentioned the strike activity, and not to delve, as an economist, I'm sure you don't want to delve into the politics around any of that, but in terms of the economics, which you must be seeing in the data, there are arguments from the government side that they can't pay any more to the public sector because it would be inflationary, but then every time we get data about the economy, there is a hit described to the economy as a result of strike activity. As an economist, do you get a sense of where how the strike activity is affecting the UK economy right now?
Clearly, right now, the initial impact is a short-term one. If nurses can't work, they can't produce the health output that they would otherwise have been. So the economy has stagnated rather than sort of improving more, as you see in some of the surveys. At the same time, if you're looking ahead, without resolving this, we have less money in people's pockets, and therefore the spending power isn't there. So resolving this issue will have to be quite important. Also for health, we know that the labour market is impacted by the drawbacks, by the long lines of delays in the NHS. So if that's impacted by strikes and that's strung out even further, perhaps the potential of the economy to grow is also impacted.
Sandra, you mentioned spending power there. I want to look at that through the lens of FX if we can. I believe out of last week, the IMF spring meetings and World Bank spring meetings last week, the consensus was that it was going to take the UK far longer to get out of any sort of recessionary period than its G10 counterparts. How does that factor into spending ability internationally for Brits?
Certainly, it has been an important fact that the UK economy has underperformed recently in terms of activity, and we don't have the room to support the economy in the way through short-term measures on the fiscal side that we had beforehand. We know that there's more of a slowdown coming. Indeed, that sort of the fiscal picture for years to come is likely to be a drag on the economy, and that will hold back activity going forward in the UK. So overall, in terms of spending power, the picture isn't looking as healthy as elsewhere. So a slow recovery is the most likely outcome.
On the global dynamics, the next sort of big data set comes out of China tomorrow morning. We're going to get an update on a suite of data there. How are you looking at the China story, the sort of the resilience or the rebound that we've seen, since the COVID lockdowns? That's clearly having an impact in some sectors, but maybe not doing as well as some thought in others. Where are you on China?
I guess it's a mixed story. On the one hand, we have signs that the global economy doing better has helped Chinese trade and exports, and that's an important part of the story. We had very strong trade numbers last week, so that gives some hopes for the GDP numbers having held up quite well. At the same time, the housing market is still an issue. Yes, we had a couple of months where the house prices have actually increased in China again, and that's a positive. But on the whole, to resolve the issues that are going on in that sector will probably still be a protracted affair that will drag down.
Sandra, I'm glad you mentioned the China piece. Let's talk about the U.S. piece. I believe the U.S. is the largest trading partner for the U.K. at the moment. And looking to talk a little bit more when it comes to trade in particular, what do those conversations look like? How do they factor into your view?
The trade discussions are always difficult ones that take a long time to make headway. We've seen lots of trade negotiations on a much smaller scale. I think ultimately the general sentiment is for an improvement in relations internationally. We've seen protocols, the Northern Ireland Protocol being now superseded by the Windsor Framework, and that's set a much more positive tone to relations between the US and the UK. And perhaps that will carry on in terms of trade figures and trade negotiations. And further down the line, that could help bring some longer-term benefits. Of course, that's a very big long-term prize. It's not something that will be resolved over time and help the UK economy to perform very strongly in the near term.
Sandra, thank you very much. Thanks for joining us. Sandra Horsfield of Investec with thoughts on the global economy and specifically around the UK. Coming up, the future of work. We asked investors which industry offers the best career opportunities. They gave some interesting insights. We'll bring you the results next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Matt Miller is off today. Let's take a look at what's going on ahead this week. U.S. bank earnings continue to roll in with Goldman Sachs, Bank of America, and Morgan Stanley reporting alongside some of the regional banks. Big tech earnings also underway. Netflix and Tesla due to deliver results. Economic data as well in focus from China in Asia this week. We get first quarter GDP, retail sales, fixed asset investment, and industrial production numbers for March. A lot to chew on there. And stateside, we'll hear from a slew of Fed speakers, including Michelle Bowman, John Williams, Austin Goolsbee, and Raphael Bostic. Anna, it is going to be a very intense week, I think, starting tomorrow.
Yeah, absolutely. Yeah, this is a slightly quieter, has a slightly quieter feel to it, doesn't it? We sit here with US futures not doing a whole lot of anything this morning. So a good time to mention our Markets Live Pulse survey this week, Kriti, which makes a fascinating read. It's proving popular on the terminal as well. The survey focus is on the future of work, and it's a survey of investors. And investors were asked where they think that the young people of today will find careers in the future. And investors say that high school students graduating this year should go into tech rather than into finance, which is where they operate. But it's interesting if you go further down the age spectrum, for today's kindergartners, is that a word? That very young people anyway, AI is seen as a threat to both career paths, and that actually they suggest careers in healthcare might be the future. And I had a really interesting conversation about AI earlier on. We spoke to Daniel Susskind of Oxford University. He's an author, and he's talked about the future of work and a future without work. And he says it really is going to be different this time. AI is not going to be a complementary force to the labour market. It is going to be something that starts to replace people's jobs. And a world without work, apparently that's a negative, just to clarify, because I wasn't entirely sure, having first picked up the book.
Yeah, I mean, well, it's already turning into a little bit of a negative, right? ChatGPT, for example, as a journalist, really quickly made the circles around here saying, look, what if ChatGPT replaces the need for reporters? So in 20 years, it's pretty clear that those little people, the kindergartners, are certainly going to be disrupted. It's interesting. Encouraging healthcare reminds me of those parents who said, well, we want you to be a doctor, so we're going to buy you your very first doctor set at age 4. Feels like that's what's getting encouraged here.
Okay, yeah, absolutely. And there's a lot of talk about empathy and whether that is the skill of the future. And so maybe we'll focus on that in future shows. That is it for Early Edition. Surveillance is up ahead. They'll be sure to bring you all of the latest moves in the markets, or the lack of movement in markets. To Kriti's point, some of the data comes later on this week. We get China data, as she was saying, tomorrow. Then we get more US data and a lot of Fed speakers as we get towards the end of the week. So we'll continue to bring you all of that news flow. This is Bloomberg.